Pinakin, the
Sure.
argument that I hear now, I have started to hear over the next last 20, 30 sessions, if you will,
Hmm.
is that at some point of time, this
Hmm.
very, very high commodity prices would
Hmm.
abate a bit. And if
Hmm.
not normalization because of
Hmm.
hopefully the conflict ending, then just the
Hmm.
demand destruction that comes about because of such high prices would lead to
Sure.
maybe some bit of a cool off in these. What is your thought
Sure.
here?
So, a couple of things, right? If you strip out the last 3 months, which is Feb, March, and April, commodity prices are or were at an all-time high when we entered Jan and Feb. Since then, they went up. Metals prices went up another 20-30%. Now, at this point, at least across the basket, we have not yet seen any material demand destruction. Now, demand destruction is going to be an evolving process. It is not going to be specific to a particular metal. It is broadly on the economy. At what point do global economies start facing demand destruction when commodity prices keep on moving higher? At least we are not seeing signs at this point. So yes, there could be another leg higher, and we could eventually see demand destruction. But the point is that if, let's say, metal prices correct 10% or 20% or whatever number you want to call it, uh, if you go back to where prices were in, let's say, 3 or 4 months back, there would still be at decadal high prices. This will still be prices at which the companies would be extremely profitable. So what is interesting is that the investor discussion has moved from a collapse in metal prices to a correction in metal prices. So now nobody is talking about metal prices going back to, let's say, 2017-18 levels. January is what people are talking about, which in our view is a healthy correction. It is not a collapse. I think we still have the fundamental construct in metals as is in energy, which is that China's decarbonization supports lower supply, even as demand growth should remain robust, especially if the world is going to do as much renewable spending as expected.
Yeah. So in fact, I was going to ask you that. So in the classic conflict between very high prices leading to some bit of demand destruction temporarily versus the expectations of a capex super cycle of sorts at some point of time starting, and back home in India, most certainly starting at some point of time in maybe early 2023 or maybe even late 2022. What does it do to companies in India which are where I believe and I believe metal prices are anyways at a discount in Asia compared to what's happening in the Western world as well. So lay out this construct for us, lay out this piece for us, and how are you thinking about what the prices behavior could be?
Sure. So generally, what happens is if you go back to the period of 2004 through 2012-13, when India had a very robust capex cycle, domestic prices would be at a premium to import parity prices, especially in steel and even other metals as well. Over the last few years, we have moved to a parity or a discount simply because domestic demand has not been as strong. Now, if we are going to enter a capex cycle in India, in fact, all the large corporates are laying out large capex programs for execution. At some point of time, that spending on the ground should pick up, and you don't have much supply of metals. In that environment, there is a very clear possibility that we can mean revert back to a premium over imported prices, especially in things like steel. And that would be obviously be very positive for the domestic companies, the domestic Indian manufacturers, because effectively they get a premium, and they need to be incentivized to add more capacity. So if you have a construct where global supply coming out of China is limited, global demand is steady, India sees a capex cycle, then you have a confluence of positives, which is global prices remain steady and India domestic premiums rise. So it's a sweet spot for the Indian metal companies.
So the lay belief is that it is a cycle, and the cycle will come off. What I'm trying to, what I believe I'm listening to you, and you are trying to imply is that yes, it may come off, but for now we seem to be in the middle of the up cycle and not necessarily towards the peak.
Sure. And the other thing I would lay out is, the definition of this cycle. Historically, take steel, for example. Since the global financial crisis of 2009 through 2020, for 11 years, steel prices were in a $250 to $600 range. Prices would bottom out at 250 and prices would peak out at $600. Now, when you look at the last 2.5 years, you have had steel prices in a $700 to $1,200 range. And in fact, when you go back to the fourth quarter of last calendar year, October to December period, when Chinese demand was severely negative, as negative as it can be, steel prices bottomed out at $850 a ton. So what you have is that the peak and troughs, or the cycle itself, has moved structurally higher. So I don't think we are going to see anytime soon prices go back to, let's say, what they used to be, the cyclical lows of the previous decade or so.
On the contrary, can this, in your assessment, is there a possibility that this band could structurally move even higher from where it is right now, or is that too difficult a call to make?
So a lot depends in the near term on China. So if you look at the metals global markets, right, it has been a supply-driven upcycle for the last 12 months or so. Demand out of China has been very, very weak. And while there were expectations of a pickup, obviously the COVID lockdowns has impacted demand. Now, there is a lot of talk and expectations about some kind of infra pickup, quote unquote, infra stimulus coming through once the lockdowns are lifted. If you enter the second half of the year, where the global supply remains as tight, and you have on the margin also a China-led demand boom, or demand recovery, then yes, versus market expectations, you could actually have metal prices and steel prices even move higher in the second half of the year.
Okay. What about the non-steel or the non-ferrous category? And I would love to understand where is it that you are constructive, where is it that you are circumspect? Because again, I see conflicting notes coming in on what could happen to zinc, what could happen to aluminum, and how it would thereby impact some of the listed stocks. So without getting into stocks, of course, but what's your thought on the non-ferrous side?
Sure. So what has happened in non-ferrous is obviously prices have rallied much more than steel. And I think the fundamental difference is that steel is a traded commodity, while non-ferrous is an exchange traded commodity. What it means is that the investors could express a view in non-ferrous versus steel, and which is why non-ferrous rallied much harder than steel did. And with the risk-off sentiment that we have seen recently, non-ferrous has also pulled back. Aluminum prices are down 15% versus, let's say, steel prices being up. The fundamental supply demand still remains as tight in non-ferrous as it is in steel. So having said this, on a fundamental basis, we don't see aluminum or zinc, at least for the next few quarters, being loose in terms of market balances. Having said this, those base metal prices will be more influenced by risk on or risk off behavior by investors who can directly participate in those commodities. Secondly, any demand recovery in China in the second half of the year from a pickup in spending would be more positive for steel and ferrous than it is for base metals. And the reason being that China is in a deficit in steel and ferrous, and therefore when Chinese demand goes up, iron ore prices go up, steel prices go up. So fundamentally, I think ferrous has a better outlook over the next couple of quarters than base metals have. But I think the underlying supply-demand balances remain tight in both the sectors.